tell you to. We need to meet. Okay, let's meet at the studio. Okay, I'll be there in 5.
My name's Priscilla De La Torre.
And my name is Jordan Hemp,
And you're listening to Off the Market Confessions,
where we talk about real stories, real estate, and real life.
Hi, friends. Welcome back to part 2 of Off the Market Confessions with your Yakima lender, your Yakima golfer, Francisco. You're welcome. Okay.
If you guys remember in part 1 of this episode, we talked about loan terminology. We went over some different terms that you'll frequently hear when you're buying or selling a home. And in part 2, we're going to talk about loan types and some little interesting facts about them. Thanks for coming back for part 2.
Yeah, thanks for having me back again.
You're our favorite.
You're welcome.
There's just so much to unpack.
Yeah.
There's so much to unpack with loans. And I feel like we're just brushing the surface.
Yeah, I think the first episode, there's a lot more to talk about. But yeah, the products or the loan types are the kind of the important part that once we go through all that first part of evaluating a person's profile, then we kind of narrow down what product or loan option they're gonna basically is gonna better serve them.
Yeah.
And it all varies, right? It all depends on what their what their credit score looks like, what their income looks like, what their debts look like, and how much money they have to put towards the purchase. And so that all gets looked at during that first phase, and then we figure out which option's gonna work. So there's a lot of different products out there. The big ones are the more popular ones are going to be your conventional, your FHA loan, and then VA, and then I'd say USDA maybe is kind of up there. It's randomly used. It's a good.
Have you ever used them?
I haven't. I've never used.
I think I've only seen a USDA loan come through maybe twice in my career, but it's weird because it is considered one of those bigger ones.
It's a cool program, but yeah, we don't see it too often, even though here in Yakima, we're in a pretty good spot to use it just because it goes off of city limits.
Oh, that's right.
So if
for
you're
agriculture,
for
But
agriculture.
why isn't it used? Isn't there a reason that we don't really use it?
They're a little more strict with income, so they put a cap on how much income you can make. The areas, here it's good, but the areas also there's restrictions on the area, and they're a little more tight on their debt to income guidelines too. So versus an FHA loan or a conventional, and you can go quite a bit higher, which is more important right now too with just affordability. We're constantly pushing debt to income percentages. I feel like majority of the time to make the deal work too.
Yeah. So before we kind of get into the loan types, let's really fast recap. When a buyer wants to purchase a home, before they start considering what their loan type is, the first step is to apply.
Right.
You don't choose your loan type, right?
Yeah.
Do they get to?
There's certain scenarios where they kind of do have 2 options,
but not before they apply,
before,
right?
Yeah.
It's after they've applied, and then you're able to analyze kind of their whole setup, their financial setup, and then you kind of help them choose the right option.
Yeah. So essentially, everyone will apply first, and that's where we see everything. We see that credit report, what credit history looks like, what the score looks like. The score is really, I think, the first piece to what's going to determine if they go, if it's better conventional or FHA, or if it's VA or USDA. But yeah, that's the first piece, credit score. And then that's going to usually narrow it down, if we're going to use one or the other. And there's sometimes where it's their credit score is right kind of down the middle between 2, where it's kind of up to them because there's a lot of pieces to an FHA loan that's beneficial, but also potentially negative for a buyer too. So I guess, for example, a conventional loan, you're usually going to get a little bit more of a deal, I guess, if you have a higher credit score. Usually, I would say higher is going to be right at 700 or above is where you start to tip a little bit more to the conventional side. And then below that, usually FHA is going to be better. The big thing is the mortgage insurance, which we talked about last episode, which is the mortgage insurance is insurance the buyer pays if they're not putting 20% down or more, essentially insurance for the lender. But yeah, if conventional is priced strictly on a number of things, but credit score is the big one. So the higher somebody's score is on a conventional loan, the cheaper that insurance is. Versus FHA is just flat across the board. Everyone gets is charged the same rate, which is a percentage basically. So for example, FHA is 0.55 if you're putting the minimum down. The percentage of the loan amount that they charge in insurance, and then it splits up over 12 months, and that's how you get the monthly insurance for it. Conventional can go down to like a point. I've seen like one was like 0.18 is the thing, or the percentage. So it can get pretty cheap once you have a higher credit score. So that's what makes a payment look better under conventional with a higher score versus FHA. A lot of factors to it.
Yeah.
So there's a lot of moving pieces even
How do
within
you
that.
remember all this?
It's tough.
Because you do it every day.
I mean, yeah, there's even like somebody's debt to income on a conventional, specifically debt to income percentage. Once it crosses a certain percentage, then mortgage insurance gets cheaper or more expensive. So the higher their debt to income goes, the more expensive their mortgage insurance can be too. So a lot of factors that will change what insurance will cost for them too.
Interesting.
Yeah, even like the type of home. So if it's a manufactured home or a single family home, that'll change the rate that they get for their mortgage insurance too. So, but yeah, really starts with credit score. Credit score kind of dictates where they might end up on program wise. But yeah, usually once we go through the full review, it usually boils down to like one option, whether it's conventional or FHA. And then from there, if we want to layer on a down payment assistance program, that's kind of goes hand in hand with either of the two.
Interesting. There's a lot to it. So we've kind of already started like brushing on the conventional topic. How can you explain what a conventional loan is to somebody? Like how would you explain it?
I guess
It's
when we're
definitely the
comparing it,
most popular.
I would say actually FHA, I mean, at least for what my business looks like
Yeah.
too, we see a lot more FHA versus conventional. And it's really just because of the credit flexibility that FHA offers. They're not going to penalize you for a lower credit score and charge you a huge amount for mortgage insurance. It's the same for everybody. So that's the big side to it. And rates are lower under FHA, but it's also because the mortgage insurance, they have a mortgage insurance upfront mortgage insurance premium. It's basically an extra fee that's financed into loan under an FHA loan that allows basically gives them the benefit to get a lower premium on their insurance and rate essentially at the same time. But yeah, conventional loan, I guess the easiest way to explain it's just a loan product that's out there. It's a big product that's backed by Fannie Mae and Freddie Mac, but it's the more common program that once you're up in that 700 range or above, that's usually where people end up financing through. FHA is backed by the Federal Housing Authority or the government or the federal government. So that's why it's more credit flexible just because there's the government kind of backing that loan too. So that's why you see rates lower and it's just a bit more flexible with it.
So if they have better rates FHA wise, it sounds like that could be a better product. However, depending on the house that you're trying to buy, then that can also be a factor as well, because when an appraisal is happening, they're really picky on the condition. With FHA versus conventional, they'll let you buy pretty much anything as long as it's considered livable.
Yeah, FHA is a little more strict on certain things, which isn't too much more than, I guess sometimes it seems like it can be a lot, but like
Paint is a big one.
is the big one, but usually an easy fix. But yeah, FHA is a little more strict on the condition of the home too. So like if there's a well too, like it requires water testing for the well. Conventional.
They require that you do a home inspection too.
Yeah.
I think they also require that you can't have broken windows or cracks in the windows.
Yeah, broken. Yeah, I mean, conventional would probably call that out too if there's a broken window, just because if it's left, basically the saying is if it's left there for the life of the house, then it's more than likely going to ruin the house too. So anything like that can ruin the home, conventional will pick up too. But yeah, FHA has a few extra things that they'll call out on an appraisal. So the conditional home has to be a little better, I guess.
I think they also call out a bad electrical panel, Zinsco or Federal Pacific panels, because VA does a lot of this too.
Yeah,
VA is more picky though.
Yeah, VA is a little more picky too. Yeah, they're all different. So they're all different products or loans that people can use, but VA is probably the better of all of them, I would say, just because VA doesn't have a debt to income limit. There's no like max. It's all based on residual income. So it's like how much money someone has left over after like their bills and everything. There's no credit score requirement for VA, which is cool. So
that is cool.
There's a lot of ways you can still get a house with like a 500 score.
Just to clarify for the people that don't know, VA is for military,
for active
and veterans,
right? Yeah. So yeah, VA's Veterans Association. it's like the best program someone
Mhm.
could get. So if
Yeah.
you are a veteran or you're active duty,
Mhm.
that's really the
Mhm.
best thing. No down payment requirement, no mortgage insurance, even if you put 0 down. So
Oh
a
wow.
Yeah.
lot of cool stuff that you can
I
do.
think the downside to the VA loans during the peak season, like
Oh,
COVID and all that, was that if you were getting multiple offers on a house and one, let's say you had 2 offers, right? They were for the same price, $350, but one is conventional and they're putting $100,000 down, and one is VA and they're putting nothing down. The conventional one was always winning
yeah.
because it's a safer bet for the
Right.
appraisal, and so that it will appraise. Which is sad because our veterans who deserve to have
Mhm.
such a good loan, they were losing out a lot because they didn't
Mhm.
have the down payment or like the good look.
Mhm.
they're
It's like a
offering.
longer period, isn't it?
Yeah, closing
saw-
takes a
I
little
think
longer.
closing-
Sometimes
it's
it's a
like a
little
little
longer.
longer.
It can take a little bit longer. We've done a couple that one of them was
Yeah.
pretty normal. Like
Yeah.
we didn't really notice a difference on our side either.
Yeah.
It
I
can
did-
vary though. It's
I
different.
did one during COVID time. This was before I knew you. It was, but I think it was like a 45-day close. It
I
took
think
forever.
I think that's what I've been told.
Yeah.
Like is
Because it wasn't
average.
me.
Probably.
You know what I love about VA loans though is they're assumable, and
Yeah.
I actually did do a deal last year. So I sold a house 3 years ago. My clients bought it and they used Rocket Mortgage, which I judged them for that, but
Oh,
it
I'm
happened.
just kidding.
It was really good. It closed really fast. They used a VA loan, and I honestly didn't even remember that that's what they got. I didn't even realize my client was military. But I know, you guys,
Cut
it
that
was
out.
during COVID. It was happening so
COVID
fast.
was crazy. Yeah,
but
it was crazy.
they were really great clients. But yeah, they used a VA loan to buy the house. Then a couple years later, he was relocated for work. He wasn't active military yet, but he was relocated back to Oklahoma. And so they decided last year to sell their house. And they had, I think their interest rate on that house was like 2.9%. And so anybody who could afford to come in with, and to explain what assuming a loan is, it's like, the house was, I think, like 400,000, or it was like right below that. And they put like minimum down. I don't think they came into it with 0 down. I think they were like 3 or 5% down. So they didn't have a ton of equity in the home, but basically the house increased in value as well. So when we went to sell it, if somebody could bring in, I think it was 80,000 to cover the difference of the equity and what my clients have put down, then the rest of the loan they could assume and just take over at the same interest rate, which
Yeah.
last year, if
That's
you could
cool.
get under 3, that's like unheard of. That was like
Yeah.
the steal of the year for this guy. And so he assumed the loan, and I think we closed that in 21 days.
That's actually pretty good.
Really
because,
fast for assuming
Who
a
was your
loan.
lender? Just kidding.
It was Rocket Mortgage. They assumed it from Rocket Mortgage.
Good.
I know it hurts, but no, and it was another agent.
Noted.
Another
I need a
agent.
backup.
Have you ever heard of? Let's see, there's Rocket Mortgage and Quicken Loans. They're really good too.
I've
Yeah.
heard of another one called like DB.
Depot.
Oh,
I worked with
Depot,
them on one
yeah.
last year too. Actually, honestly, they weren't that bad.
I heard they're not
But I always like working with local lenders because they know our market, they know our operations. You could sit down with them in person, give them your paperwork, and kind of have the hand holding. You can
Yeah.
be in the same time zone.
Or
You
if
can
they
reach
mess
them on their
up-
cell phone
I think,
after
like,
hours.
If they mess up too, like I know where your office is at, so I'm gonna come find you. I know where your house is at. I'm just getting all creepy. You know what I mean? So I'm gonna
Yeah.
come find you versus like if it's someone online,
At a
it's really
call
hard.
center.
Yeah, it's like really hard to get a hold of them.
No, it is. And
They don't answer.
I feel
they
like
don't
there's
email
some broken
back.
promises there. You know, they might give you a good rate and they like really put that out there. They're like, oh, we can get lower rates than anybody
Yeah,
else.
but your closing costs are like
Your closing costs are high.
6%.
Yeah,
The
that's
communication
that's
sucks.
something that
Yeah.
a lot of we've had it happen maybe before too a couple
Mhm.
times where someone gets hooked with like a shiny low rate and
Mhm.
and everyone can see this online. Like you'll search
Mhm.
mortgage rates and then
It's all the ones that are sponsored ads.
you'll see like usually like a much lower rate than what the market rate is, and people get attracted by that, but they don't realize that there's thousands of dollars of extra fees behind that rate because you're
Yeah.
basically paying for it.
You're buying it
And
down.
they-
Yeah.
Yeah, usually they don't figure that out until they're at the closing table or right before they
Mhm.
go sign everything, and then
Which is
at that
crazy.
point
Yeah.
they're kind of just
Like they have
they
to.
have to
Yeah.
like there's no other option.
I have a question. I don't know if we need to cut this or not, but so every lender has different rates.
Yeah,
How does that work,
every
right?
lender has different
Why?
rates.
I really don't know this answer.
I mean, the easy answer, the simple answer is just every lender has different pricing and their company itself has different like margins, I guess,
Mhm.
attached to it. So the margins are like how much money the company makes, because everyone has to make money, right?
Mhm.
So
Right.
some companies will have big margins behind their rates, and it's hard for people that are buying like to know that,
Mhm.
because they'll usually talk to like one person and then they're like, oh, that
And
works,
that's who they're
and
with.
that's
Yeah.
it. And I can attest to this because I've seen different companies in in a short amount of time.
So you've
Um,
gotten around,
I've gotten around a
essentially.
little bit,
Okay.
which has allowed
That
me to
sounds bad,
see
but
allowed me to see quite a few things.
Mhm.
But yeah, that I mean, even just locally, or like the rate's not going to be the same from
Mhm.
the office down the street
Right.
to the same office that's on the same street.
Okay, and I have another question. How come with one lender, because this has happened to us like multiple times, where they come from like a credit union or from another lender and they're not happy with that lender. And then they come to you and you
It's
either
the
have a better,
tell-all part.
yeah, you have a better rate for them or you approve them for more amounts. Why is that? That with
So
different lenders, they get different amounts.
yeah, so the first one will usually always start with the rate. Like every lender has different rates. Like someone might be offering you a 6.5,
Mhm.
and for let's just say, because everyone's going to usually pay discount points for a rate, which is the fee to get the rate essentially. So if someone's paying, let's just say 1% for 6.5, like they could come here and pay the same thing but get 6%. So
Okay.
that's kind of the difference.
Mhm.
And if they have different debt to income ratios as well, that plays a factor in how much they can get approved for in the end, right?
That too. So that the other thing is there's a lot of lenders out there, a lot of lenders with different levels of experience and understanding of guidelines and stuff. How to
Can you see how
calculate
I'm blinking?
income. But we've ran into this
Mhm.
a few times actually, where I had the one that I'm remembering. She was actually in the military,
Mhm.
and I think she was approved for like 200,000 or something.
210.
Yeah, something
Yeah.
kind of in the low twos, and then
Mhm.
I got her up to like 350, three
Mhm.
sixty. But it was because that other lender wasn't, for whatever reason, they maybe weren't seeing her income correctly, but they weren't using a big chunk of her income. And it was kind of funny because like military income's usually pretty straightforward. Like you get
Mhm.
certain percent, like certain amount for like housing
Mhm.
and stuff like that. So it's like that's kind of a simpler one to calculate. So
Mhm.
they either missed it, or
Mhm.
they didn't know they could use it, or
Mhm.
they just weren't allowed to use it maybe from.
Yeah.
So there's a lot of different factors that
Mhm.
like change all that too. So the way someone calculates just even regular income, like some places maybe are just really conservative about
Mhm.
it, or they don't get the full picture
Mhm.
like right off the bat, and then that's what creates like the differences.
To sum that up, they're able to shop lenders and everyone, for the most part, they could get different answers.
Will get
They
different
will get different
answers. And
answers.
I
Okay.
usually encourage people to do
Mhm.
that because, I mean, we're really
Mhm.
competitive, and I
Yeah.
know I'm going to put our company on the spot now.
Period.
And I mean, we'll match whatever, or even beat, more than likely we'll probably already beat whatever rate and
Mhm.
fee they have.
Mhm.
But if it gets like really deep into it, like I'm sure we're still going to come out on top for it. So and it could
Yeah.
save buyers like literally thousands of dollars in
Mhm.
fees
Right.
too, or just rate wise too. Like
Yeah.
they could get the same rate for the same, or a much lower rate for the same fees that they were going to pay
Mhm.
somewhere else too.
Mhm.
So like either pay the same fee, get a
Mhm.
lower rate, or just not pay the same fee and save some money and keep some money in pocket
Mhm.
too.
Okay.
Interesting.
Yeah, that's cool.
Spicy stuff.
It's a lot to
Spicy
unpack.
stuff. I have another question, but we can save it towards the end because this is more like, how come you don't make mistakes, but other people do? We can say that
I
towards the
do make
end,
some
though.
mistakes here and there, but
But
nothing you
well,
could.
just multiple. This has happened to me multiple times, multiple different lenders where my clients are getting misquoted like
Oh
$10,000
yeah,
the day before
yeah.
closing.
There's lenders
How does that
that
happen?
It just happened
And do
it's
they get,
yesterday.
you know what I mean? Literally, it just happened to
Two
him.
Yeah,
So,
yeah.
10,000.
so it's like,
Ours was a $4,000 difference.
So
but you know what I mean? Like things like that. I've experienced it with multiple different lenders. Thank God it's never happened with you. But how do those things, like, how does that happen and it doesn't get caught until like closing
I mean,
day?
there's
Because that's such a bad experience at
yeah,
the end.
it's I mean, for what I do, I try to, like, as soon as we're even talking about putting an offer in, I want to always like update their numbers,
Mhm.
because I mean, the big thing that'll change and can change is your rate and your fee
Mhm.
attached to that rate. But yeah, I mean, that much money is
Crazy.
kind of I mean, it could be a lot of things. There's a lot of lenders and a lot of ways lenders do things. It could be that they didn't lock their rate like at the beginning and they chose to gamble on this person's rate and hopefully comes in a little bit lower, but then things change. They maybe just suck at doing their numbers at the beginning.
Just suck at their job.
Yeah, a lot of people suck at their job. It could be a number of things. Like
I think that's in any field, but
sure. I mean, we all make mistakes.
Having a big difference like that is really, like, to me at least, it should ever happen. 4,000 or 10,000, like that's just something like I mean, there's like kind of like the same thing with like an online lender, like when they like misquote your rate, or they even like if they quoted your rate as a primary home but it's actually an investment or something changed, like that could be a difference there too, like the way you quote a rate too, because the type of home it is, the how you're going to occupy it all changes, like the cost too. But yeah, it's a lot of different reasons, but those are big reasons. That's a big amount.
Better be a big reason. I don't know.
That's a bad reason too.
That is
I would explain mine, but it's still really fresh.
Let's not.
I don't want people to be pointing fingers.
Let's not get into it. And everybody makes mistakes, so I understand to an extent. It just sucks when, like, especially when it's like close friends or family. Which in my case, 2 of the times it was family. The third time was just like a friend that I've known for a long time. But it's a crappy experience.
That was family for me too, and I feel like it looks kind of bad on us too. It's like.
I mean, it does. It always looks bad.
But we don't get to. I don't get to see all their loan numbers, but I do see the settlement statement.
Right.
But I didn't know that there was an error because I didn't know what they told them a week ago. So.
Yeah, it could. There's a lot of shady things lenders can do too. So it's in this case, it wasn't shady. It was just a simple mistake, an honest mistake. But I wanted to ask. So a lot of people will come to us and they'll say, "Oh, I want to use like a first-time home buyer loan. What do I do to get a first-time home buyer loan?"
We hear that all the time.
What is a first-time home buyer loan, and is it actually really truly a first-time home buyer loan? I don't think it is.
What is a first-time home buyer?
So it's a first-time buyer loan is not. It's not really a thing. I get that a lot.
Like realistically, it's not.
It's not a thing.
It's not its own loan.
But it's. I think, and I'll explain it too. But I think what it is just over time, people think that there's like this, and I think years ago there was like a special first-time buyer like program that was around for a while, but there's no like special like this is a first-time buyer program loan. The one that people get confused for is either FHA, or a down payment assistance program. But FHA,
which you can use both.
Yeah, you can use both.
You can take advantage of both.
Yeah. So even the down payment assistance program, like you don't have to be a first-time buyer to use it. You just can't have used it before. So someone could buy a house with their own money at first, and then they want to buy a second house, then they can use that down payment assistance program. FHA is also the same thing. Like you buy your home conventional the first time, and you want to buy your next home, you can use FHA for it. So there's no real like first-time buyer requirement with those two options. Under a conventional loan, the only difference a first-time buyer gets is as a first-time buyer, you can put 3% down. Once you're buying your next home with a conventional loan, it's 5% down.
A minimum, yeah.
Minimum. So that's really the big the difference.
That's funny because I think it's funny because that is probably one of the most common questions for people who've never owned a home is like, well, how can I get a first-time home buyer loan? And I'm like, well,
I think that's one of the bigger.
Well, you can't because it doesn't exist.
The bigger.
I don't know. If you find out, let me know because I don't know what that is.
OIC had that thing a while ago, but
there's certain like that,
but that was a grant,
like
right?
a grant, or like the state of Washington currently has the covenant program that does require that the person is a first-time buyer. So there's programs that maybe do require that you have to be like a first like that, but there's no like a conventional or FHA or
that's only for first-time
there's
buyers.
No like strictly first-time buyer.
Maybe they're confusing it with like down payment assistance. I think.
Yeah, I think people confuse it with that, like down payment assistance, because you're getting money,
right?
Like, but you're
I
not
think
really
so.
getting
Yeah,
money.
I think most of the time, actually, and I think some people think that the abbreviation FHA, somehow they think that the F stands for first home something. It just doesn't connect, but they're like, that must be it. It just must be it.
Yeah.
And then the down payment assistance, I think that's actually what really referring to is down payment assistance. But the important thing for people to know is like down payment assistance is not free money. They're
It's not.
not
No.
granting you the down payment.
It's really
It's a
lending it,
secondary
yeah.
loan basically
it's-
on top of the rest of the
essentially,
mortgage.
another question that I get too a lot, like how does the down payment assistance work? Like when I tell them like what they're approved for, and basically all it is like you'll still either finance the house, whether it's a conventional loan or FHA loan, or well, I guess USDA. Yeah, I think Well, I'll have to check that, but I don't know if you can use down. Yeah, I don't think you can use down payment assistance with USDA, but because they already have 0% down. But yeah, if you're conventional FHA, you can add that down payment assistance program to it. So you're getting a second loan. So you have your first traditional, and then the down payment assistance is a second loan is financed at 0%, but you don't have to make a payment on it or anything like that until you either sell the house, refinance the loan, or you just keep that same loan for like 30 years and then at the end you pay it off.
So if they grant you $7,000, you're only paying $7,000 on that, and
Right.
essentially interest free.
Yeah.
It's a free loan.
That's good.
So it's
That's
a good.
That's still
that is a
good.
benefit.
Good
That is
part.
a
And you don't have
benefit.
to have it up front, which is nice
Yeah.
too.
Yeah, but the thing that we're also running into too, like down the road, like usually when you use a down payment assistance program, the rate's a little bit higher than you would get under just a traditional FHA or conventional loan.
And
It's
that rate
kind of
is with
not necessarily free. It's just being offset somewhere else.
Right. Yeah. So that's kind of the trade-off.
What
but,
were you going to say?
but that rate is with the same with every lender, right?
Oh,
'Cause it's a state program.
So yeah, that's
Yeah. So if you go to Francisco and he tells you it's 10%, and then you go to Joe Schmo in whatever other company, it's still going to be the same amount.
Yeah, so
right?
that's really the only program, anything that's a down payment assistance program. Well, the one we use and everyone really uses, it's through the state of Washington. But that rate's going to be the same whether you go to lender or on 56. It's all the
What's
same
on
because
56?
I don't know. There's something there. Actually, there is something there.
Alone?
That's
In 56, I think there is
Is there?
a financial institution.
Celerity? I'm just kidding. Is
Actually,
there? No, Solarity's on 53rd.
Yeah, I don't know. There's something there, but
Interesting.
yeah, that'll be the same rate with any lender. But if you're doing just a traditional, conventional FHA, VA, USDA with your own money, then that's where your rates are going to look different from lender to lender and your fees.
Okay, one more test for you. Let's see if you know this. So, what sets you apart from a bank?
From a bank
Mm-hmm.
or a credit union. So like we as a bank or credit union, like their focus isn't on mortgages. Like they have, auto loans, checking accounts, saving, banking stuff. So, and they're even though they're like a bigger bank, their focus is not strictly on that. We as a company, like that's all we do is mortgage loans. So we have like capacity to be more competitive with rates, with fees. So that's, I think, the big difference.
More loan options
Yeah,
too.
way more loan options. Like we can literally finance probably any scenario. We broker sometimes through different lenders that offer like unique loan options for unique borrowers and stuff like that. But yeah, that's not their priority. So and how we talked about last time, they're a little bit more, well, they want to prevent as much risk as they can in these bigger loans. So they're going to add in extra requirements or just more restrictions basically for somebody to get a home loan through them.
Yeah.
That makes sense.
Yeah. I think banks and credit unions only typically will do conventional loans unless it's a type of refinance, which could be like a HELOC. They can do a HELOC, right?
Yeah, I remember when I was at Celerity back then, that's all we had was a conventional loan.
Yeah.
And then at some point they tried like VA and FHA, but then it was too complex of a process for them or something on the back end that they just stopped. I don't know if that's changed.
So,
but
if someone's gone to a bank or a credit union and that credit union has told them, no, you don't qualify, come see this man.
and I'll also point
Right?
that out. So yeah, when I was started at Celerity, I was doing only conventional loans. That's all that they offered. So there would be a lot of people that I would say no to, but I would refer them to someone else because I knew that they had FHA because it was simply like a lot of people like the credit score is what kind of knocks somebody out from a conventional loan because their conventional is pretty credit sensitive. So if me telling them no, and a lot of people probably heard that from their bank or credit union because they don't offer FHA, they were usually just told, oh yeah, we can't qualify, and they probably weren't given like another option.
Right.
They were just told no, like come back and see us when
you
do all this stuff or something. But
money.
at that same time, they could have qualified for an FHA loan. So yeah, we run into that a lot too. Like someone that comes from a bank, especially if they get told no from a bank or credit union, you should definitely talk to someone else that's
Yeah.
not in the bank or a
Yeah.
company.
Yeah.
Yeah.
'Cause
Because there's
it's
more options.
yeah, there's more
Yeah.
options.
Yeah.
Okay. Cool.
Can we real quick explain a little bit about what the covenant loan is?
Yeah.
Because I think that there are some like really massive benefits there. But I know right now it's under like federal review,
It's
so whether that
receivable.
stays
Magnifying
a
glass.
program or
Is it
not.
really?
Yeah.
Oh.
They
So
might take it away or they might change the terms.
yeah,
Maybe.
so the covenant loan is a super cool program. It's offered through the state of Washington. It's you do have to be a first time buyer, but basically what it does is it gives you 20 it doesn't give you it's a down payment assistance program, potentially forgivable, but what they initially start out is 20% down. So they give you 20% down plus closing costs. So all that money is like really saving. It's money that we don't have to count as a payment either. So you're not giving a payment on it either. And also what that does for people is when you're putting 20% down, it increases their odds of approval. If you're going under a conventional loan, you don't have to pay a mortgage insurance either. But yeah, it's a program that's geared towards a first time buyer. You do also have to have family that was here before April of 1968. And they also have to be classified under certain ethnic groups. So if the big ones are Black, Hispanic, Native American, Pacific Islander, Korean. There's a big list. But yeah, if we can document that someone had a parent, grandparent, or a great grandparent that was in the state of Washington prior to that date, even if it was just one day, they didn't have to they wouldn't have to have been born in the state of Washington, just that they lived in the state prior to that. Then they would be able to qualify. So then we just have to document, essentially have to prove who that person was and then the relationship to the borrower. So if you had a parent, grandparent, or great grandparent that falls into that criteria, then you can qualify to use 20% down from the state and then closing costs. So it's a pretty cool game-changing program.
Yeah.
But it is currently under federal investigation.
What does that mean?
Under the House.
Because I hadn't heard of that, honestly.
Yeah, this was just last week.
Yeah.
Okay.
HUD sent a letter to the state of Washington saying that essentially they're investigating this program for being discriminatory. So it's usually once the federal government gets involved, it's a little more like real and they have a little bit more sway, I think. But I mean, the programs face legal stuff like that before and they were successful in court. So
Okay.
who knows what will happen, but it's tough to say, like if the government says let's just stop it, like they kind of have the power to just do that and then all of a sudden the program's gone.
Wow. But if
So
someone's pending with it now or is looking now or is gonna
uh,
apply now.
that's also
Still
like,
not a guarantee.
yeah, it's not a guarantee.
Ugh.
Like anything can really
Dang.
happen. Like
Well, I mean, remember what happened with OIC?
yeah. So IC offered a grant last year.
We should tell that story.
Yeah, that was
We
an
literally
interesting
had like
story, too.
3 offers that we submitted, and then they told us like that the program's gone. They didn't even tell us. I think we found out
Yeah,
through
we found
somebody like
out
in your
somehow.
office, Matt. And
Yeah, we had someone, Matt, shout out Matt.
then,
He had a deal going through and then I think he was told that this was like the last one.
like it happened to him
Yeah.
where either he did get it or he didn't or something.
Yeah.
And then I was like, what do you mean? We have 3 offers we sent out that, we said we were going to use this grant.
that kind of sucked.
And then
yeah.
I think 2 of them fell apart, but one of them, they ended up qualifying conventional and then we closed.
We
Oh,
figured it
man.
out.
Yeah, we figured it out, but
Wow.
There was
That was not nice.
like during that time then because they had also at first I think it started at 20,000 and then they increased it to 20%, which that was like that's when it all
that's
got
crazy.
crazy.
Yeah, that's insane.
And I think we had
Yeah.
one person that like was like should have taken advantage of it, but they kept like backing out because the payment they wanted the payment to be like $100 less but they were getting 20% down. Like you have to take this.
Yeah.
What are you doing?
Gold.
And then it was
And it was
too
a
late.
grant. It
was a
wasn't.
grant,
It
yeah.
Yeah,
wasn't.
that was a grant.
That's free money.
Yeah, free money. And like I just remember that person too. I'm like, what are you
Yeah.
doing? Like
She's still looking too. She's still interested.
yeah. That
That's
was
not.
Yeah.
but that was a grant and those come up randomly too, like where you do get free money.
Mhm.
And then you have that one, you had to be a first time buyer too, and had to do like some like counseling classes and stuff for home ownership. But yeah, every now and then we'll get random grants that pop up like that too. So
That's pretty
And
cool.
did you have to qualify like under a certain income for that one? Income level?
I'm trying to remember for that one. I think actually, yeah, there was an income. Yeah, because that also changed too. I think they started at like 100%. Yeah, then they took it up to like 140. So they started at 100% of AMI, which is the area median income for the county,
got it.
Mhm.
which I think at that point was like 77,000.
Mhm.
Which once we put two people on there, like no one really like would qualify for it. But once they raise it to 140%, then it
Crazy.
started opening up more.
Nice.
Wow.
Okay. That's cool. Yeah.
That is cool.
Did you know that with the covenant program, so that they give you the 20% for your down payment, they also cover closing costs. You can use those funds for closing costs to pay your agent's commission.
Yeah. Yeah, actually,
So
I did
if
not know that.
If you want a house that the seller's
good
not
negotiation.
offering anything, typically buyers can't really afford to pay that on top of their down payment and closing cost. So we expect the seller to hopefully cover that or work with them. But the buyer, if they're using this program, if they find a house that they're not offering that, they can say, no problem.
We'll
We
pay
got
the
it.
difference.
That's still a loan.
Still,
So they're still going to pay for that. You're still technically paying for your agent's commission, but it doesn't come out of pocket up front.
Yeah, there's
Can't
with
do that with
the-
other loans.
No, yeah, with the covenant loan though, there is, if you make 80% or less of the area median income, it's just last year they said it could be forgiven after you
Right.
live in the house for 5 years. So in that
Right.
case, like, yeah, you could throw in the agent commission, it's free.
Yeah.
But yeah, other than that, if you're above that 80%, it's still a loan. So same thing, you're not paying any interest on it, you're not making a payment on it. It's only due if you refinance a loan, sell the house, or pay off the loan in 30 years, and that full lump sum is due. But
Sounds
once-
scary.
but
Don't
usually-
say that.
but yeah, usually
Don't
like
say that part.
the solution at that point is just to refinance the home, take that equity out of it to pay off your whatever amount that is, and then
Mhm.
you can pay it off on your own pace instead of
Yeah.
all at once.
So when you get something like that, that's like down payment assistance of any sort. When you have your mortgage payments, does it show all your debt combined, like your total payoff amount on there, or does it break them separate?
It breaks them separate, so they usually get two statements. They
Okay.
usually get the main one and then the down payment assistance one. I don't know if they do a monthly one or like
And on a monthly mortgage payment, because I've never used down payment assistance, so I don't know. But like when you make a monthly payment to your mortgage, it's only paying down the
Oh,
first mortgage. It's not helping.
right. Yeah. So you're only paying down your first mortgage. The down payment
Just kinda
assistance
sits
or the
there.
second one just sits there for
Mhm.
the life of the loan.
If-
Forever.
And if they end up staying there for
Correct.
a long time, if they stay there for a long time and they pay off their house,
It's
they're
due at the end, isn't it?
yeah, it's due. But what happens if they don't sell? They just pay that in a lump sum.
Yeah, they'd have to pay it all at once at that point,
Oh, geez,
which is
that could
probably
be
rare that
hard
that
pill to
happens.
swallow. Yeah, I know.
People, when they use down payment assistance, most people will like live in it for a few years and then refinance out of
Mhm.
it. And then ideally, like after you've lived in the home for a while, you have some equity or value that's gone up, and then you can refinance, pay off the
Yeah.
down payment assistance, which gets
Move
combined
the
into one
funds around.
loan.
Yeah.
So
Okay.
that's
Makes
typically
sense.
the routes that people want to take.
That's good to know.
So let's backtrack just a little bit. We talked about the loan types like conventional FHA. You talked a little bit about private mortgage insurance and how your credit score can affect your monthly mortgage insurance. So just to remind everybody, monthly mortgage insurance is if you have 20% or less down, you're usually required to pay that mortgage insurance. So you have some numbers here to kind of explain the difference in mortgage insurance. I think that's really interesting.
Yeah. So it's kind of what helps people decide too, and helps us decide like what's going to be the better option for people. Because at the end of the day, I think people are really more focused on payment versus the rate, because the rate's going to be whatever the rate is at that point in time. But yeah, if conventional is always more credit sensitive. So when we price out a conventional scenario, the credit score really plays a big factor in there as far as like what rate they're going to get and what the monthly mortgage insurance is going to look like. So I did run some numbers. These are pretty current, but yeah. So if we're going into conventional, and here's like the difference and what kind of shapes people's decision. Somebody with a 780 score or above, which is the top tier of credit when you're in the mortgage world. So that's like the best credit. Anything above
Mhm.
that's the same. Their rate right now would be about 6.25, and their mortgage insurance would be about $58 per month. So if we take that same person under the same loan, same conventional, and their score now is at 620, their rate goes up to 6.875, same cost and fees and all that, but their mortgage insurance also goes up to $318 per month.
Wow.
That's
So-
crazy.
That
so
is
it's
crazy.
$318 versus $58.
It's about a
And that's just
$260 increase.
So that's why credit matters.
Credit matters.
Yeah.
yeah.
But when we take that same 620 score and now we price it under an FHA scenario, their rate goes down to 6%.
Ooh.
Same cheaper in cost if we're comparing everything the same. And their mortgage insurance is $160 per month. And that $160 would be the same if they had $650, $680, $780, anything. So FHA is flat across the board. They charge the same rate. So that's what makes somebody's decision a little bit easier, because usually there's a payment difference. And there's some cases where they're kind of right in the middle of everything. It's maybe off by like $20-$30 is the difference in payment. But that's why someone with a really good credit score under a conventional loan, even though the rate's going to be a little bit higher than an FHA scenario, like their payment in total is going to be much less because of that mortgage insurance, because they're paying like a pretty cheap mortgage insurance on there.
That's crazy. I learned something today. Yeah, I didn't know that.
What do you think the highest mortgage insurance is that you've seen?
I've seen, this scenario was like, the percentage was 1.15. I've seen, I quote it for fun sometimes, but it's like 1.5%, which...
Like dollar amount wise, what's the highest you've seen that someone have to pay on a monthly payment?
Well, after a certain point, like it's just better to go FHA. Once someone like is paying like more than $200 a month under conventional, and then it's better to just go FHA.
What if they have flood insurance? How much is that?
Flood insurance,
it's more expensive,
it's
right?
a little more expensive. It's starting to get cheaper now, but it used to be like pretty expensive.
Yeah, I remember.
$1,500, $1,600, $1,800 per month.
$1,800 per month?
Oh, sorry, per year.
Oh, I was like, what?
Yeah,
that's more than the mortgage.
It used to be more expensive than that. Yeah, that adds a whole nother thing to somebody's payment. Yeah, the payment, there's just so many pieces to the payment too, that the mortgage insurance is just one of them, and then more pieces in their application that can change mortgage insurance. So like conventional, like credit score is the big thing. Like I said, the type of house will change your mortgage insurance. Your debt to income percentage will also raise or lower your mortgage insurance cost. So this is like a pretty kind of happy medium scenario with everything else. Every little factor can change your scenario. Confusing sometimes. It's a moving target.
That's why I send them to you, because
that's right.
I'm like, whatever, talk to
Francisco. It's there's a lot of pieces to put together. But
so let's explain real quick, what are some other loan types that are, aside from the four, like conventional, FHA, VA, USDA?
So then another one's a jumbo loan, which is if you're going to finance more than the conventional like limit, which I think it's like 5. I should know this, but it's like 5.
They always change.
Yeah,
they
do. They increase them every year. But I think actually this year it's like over 600,000, give or take. I usually don't take people that much over, but yeah, jumbo loan is if we go above that. If we need to go higher than the conforming limit.
So if I need $1 million,
yeah, you have to put 10% down.
And usually, jumbo loan.
And you need a jumbo loan, yeah.
Jumbo loan. I like that.
There's also construction loans too, which those are that sometimes people confuse construction loans with them needing it for like a development, like a house that's getting made, like a Hayden home or a pro-made home or anything like that. Like you don't need a construction loan for that. You can still do a conventional or FHA.
Yeah.
But a construction would be if you're gonna find your own piece of land and
and your own builder,
your own builder and everything like that. That's when you would need a construction loan. And those are kind of a whole different animal process wise, because it can be like a years long process to get everything like from start to finish.
And to make it like really simple, isn't it kind of like a 2-part thing where like they can grant you the money to go buy the land, but then the rest of it will factor in when the house is finished or whatever, and then like they wrap it all together in the end or something like that?
Yeah, there's different ones. There's like, we call them on our world one-time close or a 2-time close. And we have a one-time close, which basically bundles all of it together. So you can buy the land all in one, and then you can start your draw process. So it's basically like paying contractors and everything to set up, get the site ready, foundation, get the build and everything going. And that's usually just one time. So you just do one loan at the beginning, and then at the end, it just converts to a regular conventional loan or FHA loan, whatever it ends up being. But yeah, the process is pretty lengthy sometimes. And you, as the buyer, you kind of have to have a lot of stuff like pretty much ready to go. And that's the part that sometimes scary, especially like, I
Mhm.
mean, I don't really see too many first time buyers doing that.
I wouldn't.
For
I've had
sure.
people come to me before that are wanting to like, they've never owned a home and they're like, yeah, we want to find peaceful land to build our own home. And I'm like,
Mhm.
I get
Yeah, I
those,
know.
get
Me
those
too.
every now and then.
you have
like,
no idea what you're walking into.
Yeah,
And
don't
they
do
end up
that.
always
Yeah.
buying a house instead.
Mhm.
Yeah,
It's just so many pieces.
many
It's more
pieces.
expensive than people think. It's
It's-
not like building in like with Hayden Homes, you know,
Right.
where everything's already set for you. It's not. It's nothing like that. So
Yeah, I think someone ideally, if you were to do it as your first time, you'd want to be somebody that like has good connections with
Mhm.
contractors already, like people in that
or you're a
world.
builder or
Or you're a
something.
builder,
Like you know what you're doing.
all that stuff, because you have to go get plans, you have to get permits,
Prints, this
all
kind
the
of stuff.
You
land.
do tests, you have
There's a
perk
lot of
testing.
Yeah.
lot of stuff that goes into that, and it's kind of complex.
It is. It is. So what about a FHA rehab loan?
Yeah,
Or just a rehab loan?
rehab
or
loan.
FHA?
There's different. Conventional has this as well. FHA has. They're kind of the same between the two. They kind of have the same criteria, but there's programs within those two, conventional or FHA, that allow somebody to buy a home and then rehab it. So there's
It's a loan for the purchase, but then they also give like money for
some
the
money to
rehab
fix it up.
costs.
Yeah, even just to renovate it or remodel it. It doesn't have to be like an inhabitable, and it can't be really an inhabitable home. It has to be habitable at first, but
Mhm.
Yeah.
you can do like kitchen remodels, you can do bathrooms, certain ones allow you to put a pool into the house too.
Wow.
So depending
Did
on the
that one.
program and like the work that you're doing, there's like usually two options within each of those, and that allows you to do all that. Like you can do all those updates to it. But yeah, it's a pretty cool option, but kind of similar to a construction loan. It's not as like crazy, but you would really want to have a contractor already in line, like
Mhm.
someone that's kind of done this before
Mhm.
would benefit from that program. But it allows you to renovate the home and pretty much put equity into it right away too. Because most of the
Yeah.
time it appraises for more than
Mhm.
more than what the cost to do it is too.
Right. Well, when they do the appraisal, they're trying to appraise it for what it will be once the work is
Right.
done.
Yeah. Yeah. So that's where, as the lender, we appraise it, but we also rely on all the basically how it's going to look finished. So that's
Mhm.
where the buyer has to have all that kind of ready. Like they have to have all the work they're going to do, like
Mhm.
itemized blueprints and all that stuff
Yeah.
too. So
Yeah.
it's a process, but it can get done. It's doable.
Yeah. I started one once, but it didn't make it because the well dried up. There was no
Ew.
water. And thank God we did a well test on that because, there was no water.
I think you can put a well with some of those funds, but I'll have to check.
It was
I'll have to
just,
check.
it was going to be overwhelming for them. So they walked away. The house
that's okay.
house was borderline uninhabitable too, actually. So it would have needed a lot of work, but yeah, I think it was a blessing in disguise that they walked away from that one. Can we talk a little bit about refinancing homes? I mean, because we
Yeah.
don't really do a lot of refinance stuff. I mean,
That's
in our
true.
world, but that's a big part of your world.
That is,
and
yeah. So
there's a lot of different refinance options too.
a lot of different options and a lot of reasons people will refinance. And there's basically two different types of refinances. There's like the regular traditional one where I guess there's three. You can refinance the balance that you have now, your loan. Most people will do that usually if they're trying to lower the rate, or that's the main goal. Or like if they're able to remove private mortgage insurance, they
Yeah.
refinance for that reason. And so that's kind of your standard one. We call it a limited cash out refinance. And then there's a cash out refinance. So a cash out is somebody that wants to pull cash out of the house.
Yeah,
So
equity.
essentially. So we refinance their current loan. And then based on whatever the value is of that home at that point in time, we can go up to 80% of that value. So if their home's 500,000, we can lend up to 400,000. And whatever balance they owe, that difference is the equity essentially. So then they can take all that cash out and
Do whatever.
do whatever.
Yeah.
technically.
I had someone do that, and then we bought a duplex cash, and
Yeah.
we won.
Yeah,
We beat other people.
A lot of
Yeah.
people also. So the other one would be a home equity line of credit. So there's a HELOC or a HE loan or home equity line.
Mhm.
So there's home equity line of credit, and then there's a home equity loan. One of them's like a credit card. You can access it usually like 5, 10, 15 years. You have access
wow.
to it. That's what some people will do with like when their house is pretty much free and clear. They take out a HELOC and then they just have
They treat it like a bank,
Yeah.
kind of.
Yeah.
Yeah.
just have money ready to go. So in case they want to buy a house or something, it's literally cash. So they just draw it out.
Yeah.
And then when it comes time to write an offer, it's just cash.
It's just cash. Yeah.
But yeah, you can use that for anything too. So you can use a HELOC to pay off debt, higher interest debt too. So like a lot of like credit card balances. It's kind of, I guess, shocking, I guess, to me. Like every time we pull credit, there's like, we see everybody's debt. So sometimes I'm surprised about like how much debt people have.
Mhm.
And like I've seen like some high student loans too. And it's just
Yeah.
wow. like,
Crazy.
crazy.
Eye-opening for sure.
Yeah,
Mhm.
but that's what people can use a home equity line for. Really anything like remodeling your house, you can use a line of credit. So the difference between a home equity line is that you're not touching your regular mortgage. So if you have, 2, 3, or 4%, people don't want to mess with that. So they get a home equity line of credit and just a separate loan under the house, or your second mortgage is what it's known for. But it's a good tool because you don't mess with this original payment, but you still have access to the equity that you have in your house
Mhm.
too.
Yeah, that's interesting. Yeah,
Yeah.
I've never really known the differentiation between a HELine and a HELOC.
Yeah, the loan is just it's kind of like a cash out, like you just get a one lump sum and that's
Yeah.
your home equity loan.
Yeah.
Or you can do a home equity line of credit and then you just
Right.
have access to it.
Mhm.
Yeah. And speaking on HELOCs or HELines, people will use that a lot of the times to take enough out for a down payment on another home or to purchase another home.
Sometimes,
Mhm.
yeah.
But then kind of that also brings in bridge loans.
Yep.
So how do bridge
I don't
loans
know what
work?
that is.
These aren't
So-
very popular.
So
They're
bridge
kind of
loans
expensive.
Are a little spendy, and we do have access to them too. But they're kind of like, it narrows like who can use it. So it has to be like someone that has very little debt, because you do have to carry most of the time like both payments for a little bit,
Mhm.
and you have to qualify using that. But a bridge loan essentially would be a way for you to get your next house without actually having to sell the first one.
Yeah.
Because most people use the proceeds from your first sale towards the next one as their down payment.
Right.
But when you can't do that, or just like not competitive enough, you can do a bridge loan that basically gets the cash from your first home and then gives it to you beforehand, before it sells. And then usually the bridge loan product will take care of like selling the house technically at that point.
Yeah.
In a
Yeah,
way, roundabout way, I guess. But
Yeah, there's, like a lot of these mortgage lenders have different like programs. There's one in town. It's called the Cash like program. It's like their name, Cash, the name of the company, and then Cash program. I don't know if you know what I'm talking about. I'm trying not to like give a bunch of
think I've
names.
heard
I don't
of
want
it,
anybody to say that I'm misquoting, but
gotta tell all here, Jordan.
yeah, right. So, but it was like kind of like that. They had a program where they said like, "Oh, we'll give you cash to go buy a home,
Mhm.
but you have 6 months to sell your house,
Yeah,
your
that's-
first house."
Kind of the same.
So
Everybody uses
that's
the
kind of
same
like a bridge, but
product. Yeah,
and then there's another one. Another company had like an all-in-one loan. Do you know what that is?
all in one. Yeah,
Mm.
we have access to that.
Isn't that
too.
kind of like a HELOC though?
Yeah, so the way the all-in-one works, I probably shouldn't be talking about it because it's not our product, but it's a cool product. It's basically a home equity line of credit. So it's a line of credit
Mm.
off of your house. And essentially what most people, or ideally what you want to do, is pay off your mortgage with it. So you get rid of your first mortgage, and then essentially all your deposits go into that. It's a cool product. So all your income goes into that line of credit. So essentially what you're doing is, even if you have like a low rate, this is basically a good way to like pay off everything early, because as your income sits in there, even though it's sitting in a line of credit or paying down your balance, in the meantime, that interest that's being charged every day is less. So like, let's say,
Right.
and most people even more you'd want to add like your cash savings. So you'd throw, let's say you have 50,000 in a savings account, you throw it into the line of
Because
credit.
you're paying your
you're paying
principal
it
down
down.
way faster, so the interest is accruing at a way lower rate.
It is a higher rate, like it's probably like a 7 or 8% or something. But yeah, the fact that you have not only your daily income or your monthly income coming in, and if you throw in your cash in there, like let's say your balance originally was 300,000, but you have a total of 100,000, you can bring that balance down to 200,000. And then as your income comes in, that also like brings it down kind of on a daily, because interest gets charged on a daily basis.
Mhm.
And so every day that you have less of a balance is less interest that you're
Right.
being charged.
Are those adjustable rates on that one?
I believe, I'm not for
Can't remember.
certain. I think they are adjustable, but I'm not for sure. It's
I've
not
heard
our
of other
product,
ones that are, but I like to think of that one like, to put it like really simple, is you think of like your mortgage. Your mortgage is a debt against you. But if you can think of it more of like an account, like a bank
it's
account,
basically,
you're putting money in there and you're paying that mortgage down. You're putting like your whole monthly check, all the money you bring in on a monthly basis. You can put it in there. But the difference is you can have a card associated with it. You can spend out of there. So you're actually pulling the money back out that you spend for your grocery, gas, your bills. And so any extra money,
That's too much.
but like any extra money that you technically would have had in savings at the end of the month with a traditional mortgage, it's staying there, which is paying your interest down and paying the mortgage off faster.
So you technically wouldn't have a savings for a while.
You wouldn't, no.
You're paying less in interest.
Yeah, and I mean, I think they say the rate that people pay off their homes is like way
drastically
faster, 7 to 15 years faster, I think. So
yeah, it's really a cool product, and it works ideally more for people that have a higher balance or have just a bunch of other debt too. If you have just a mortgage and you don't really have much other high interest debt, if you have a mortgage with a low rate, then it might not make too much sense. Yeah, you just have to run numbers on it to see like what the big difference is. But it is a cool product because you're.
Do you guys have anything like that? Nothing like that.
Nothing like that. And we do broker that product out, but we don't have our own synergy all in one. Maybe one day. I mean, I'm sure. Yeah, maybe.
Well, they're always coming out with new creative things.
There's
like
new products.
Who comes up with this?
The goal in the mortgage world is to try to make it more affordable to become a homeowner. I mean, or to refinance. I mean, the more money that people can save, the more spending they can have on further assets and stuff like that, or living the life that they want. So that's awesome. I think that might cover it all, you guys.
Most of it, yeah.
You want to come back for part 3?
We could do a part.
And we'll call that one the first T, where you teach us how to golf.
Oh yeah, we should do that. OTMC goes to the course. OTMC hits the golf course. Well, thanks for being here. Your Yakima lender, Endless Home Loans, your Yakima golfer.
Follow me on Instagram.
Follow him on
Endless Home Loans.
Follow him on Instagram. If someone tells you no, he will tell you
Come
yes.
Talk to me. We'll figure it out.
And if you want to find their office, they're on 48th Avenue, but they also have a little sub-satellite office here at our Keller Williams building. And you're not in every day, but you guys rotate positions in our office here. Yeah.
He's everywhere but nowhere. But he's working.
And if you want a better rate, talk to us.
And if you don't want to talk to him, talk to us and we'll connect you.
Yeah, people
to the right person.
Whatever.
Cool.
Priscilla. You know that you're always going to refer to him.
Well,
all right. Well, thank you for watching another episode. Make sure you share and like and do all the things. Subscribe. And we will see you next week when we have our dear friend Nick Feist, our favorite photographer, on. Yep.
That's gonna be good.
We had a good filming with him, so I'm excited for that episode. So
thanks, guys. Bye.
See ya.